It seems like things are little too expensive. There's probably a little bit of FOMO, fear of missing out right now, where high markets are sucking people in at these levels. Markets are priced for optimistic scenarios, probably a little bit ahead of itself. The risk is you get something to really worry about, and if that happens, the market might have to price it very quickly.
Welcome to Rise Up, where we take a look at each week at the biggest stories, those that really may impact your portfolio. And we help you understand that through our experts on our show. We know there's been a lot of changes going on, and our job is to help you understand those changes so you can make the best decisions to grow and protect your portfolio. My name is Terri Kallsen. I'm a certified financial planner. I'm a managing partner at Rise Growth. And Joe Duran, who is also our co-host, isn't able to be with us here today, but we do have two experts with us today from Grimes & Company Wealth Management. First, I want to welcome Kevin Grimes, who's the CEO of Grimes. He's also a CFP and a CFA. So welcome, Kevin.
Hi, Terry. Great to be here again.
Wonderful. And then we have Chris Deeley, who's also a financial advisor at Grimes and works with clients every single day on their financial plans, helping them reach their financial goals. Welcome back, Chris.
Thanks for having me, Terry. Excited about the next half hour.
That's right. All right. Well, let's get right into the markets. It was a good week at the S&P 500. It hit its 9th record high for the year, while the NASDAQ hit the 10th. Kevin, how many analysts continue to warn of a potential economic downturn later this year? Does this really reflect the realities of the market today?
Well, I guess we could start with valuation, right? I mean, the markets are very expensive. Like you just said, we're setting new highs, really in almost all of the stock indices, or we're close to them in almost all of the stock indices, most sectors. The S&P is at 22 times forward earnings. That's high. That's compared to 17 times as the average over the past, say, 30 years. But the economy's been very resilient, and the things that matter the most have been holding up. The jobs market's hanging in there. The surveys have bounced back from some, I guess, lower readings during some of the tariff concerns, and the earnings have been good. So, so far markets have been shrugging off tariffs, even though I would say that a lot of the tariffs that are going to be enacted in the next couple of weeks are at levels that are pretty close or the same as they were on Liberation Day. But there's no trade war with China. Deals are getting done, so there's some clarity. Everything just seems more orderly. So the markets are just looking past tariffs. And then we were told by a lot of the analysts out there and economists that we would get big inflation numbers as a result of tariffs. People were worried about 4%, 6% inflation numbers we were hearing from some people, which seems kind of ridiculous in hindsight. But these terrible inflation numbers thus far that just don't exist. Inflation came out this past week. Numbers were both, the CPI and PPI were both very reasonable in the mid to high 2% range. So look, analysts have been talking about downturns in the economy for years. It hasn't happened. And when there is a downturn, the Fed's got a lot of room to cut rates, which we can talk about later on. But at 4.25 now for the Fed funds rate, most would agree that there's a lot of room, for the Fed to start cutting, and that would be a tailwind. So, are the markets reflecting the economy? I mean, I don't know. It seems like things are a little too expensive. There's probably a little bit of FOMO, fear of missing out right now, where high markets are sucking people in at these levels. Markets are priced for optimistic scenarios, probably a little bit ahead of itself. The risk is you get something to really worry about, and if that happens, the market might have to price it very quickly. So for now, stocks are grinding sideways near all-time highs, and that's how it's been so far this summer.
Yeah, Chris, along those same lines as Kevin was saying, earnings are exceeding expectations for so many companies. Jobs and most economic data aren't really reflecting those concerns. But we also know there could be concerns out there, such as interest rate shock, consumer exhaustion, commercial real estate, regional bank stress, Are there signs that the economy could possibly drop off in the fourth quarter?
Well, as you said, Terry, I think the most important thing that we're looking at right now is earnings. And as you said, across the board, companies are beating expectations this quarter. We started last week with the bank earnings, and the banks, again, passed their stress tests. And the economic activity that banks are seeing continues to be very resilient. This week, we saw many consumer readings in earnings reports. We saw Netflix last night. We saw American Express today, which really have good read-throughs for the consumer, both very good earnings reports. And also we saw Pepsi early in the week, again, exceeded expectations. And even in areas like healthcare, which have been laggards this year, Johnson & Johnson had very good earnings. So you're seeing really good earnings. So to get to your question on is there something that can really, slow down the economy? Yes, absolutely. But as of now, we're not seeing that. As Kevin stated, the jobs numbers are okay. You're seeing some initial claims, peaking a little high, going a little higher. But certainly there could be an external shock that could lead to some downturn. But as of now, there's absolutely there's no readings out there that would make us think that there's going to be a downturn in 2025.
Yeah, I was actually thinking about our viewers and what would be some signs of, potential downturn. Certainly we have the continued escalation in China and Taiwan, the Middle East, Russia, Ukraine. These could disrupt global supply chains potentially. There could be a sudden GDP contraction, potentially spiking unemployment, credit crunches, and even a reduction in consumer confidence. Now, none of that is happening today, but if I were a viewer and trying to think, well, what could happen? We could start to see some of those things. So that's why I'd invite our viewers to keep coming back every week so we can give you updates on these, because none of us have a crystal ball, but we certainly are watching both sides, the ups and the downs. And we'd want to invite you in also for you to think about getting your portfolio reviewed on wealthion.com. Remember, we offer a free portfolio review so that you can weather any of these potential downturns that could happen potentially over the next quarter of the next year or so on. But let's get on to our next big story that many people are watching. What will happen with the passing, of the Genius Act, which for the first time provides a federal framework for dollar-backed stablecoin and regulation. And when you think about this, the stablecoins, USDC, USDT, PayPal, USD, these are tokenized dollars that can be transferred instantly 24/7. So for Kevin, for those of our viewers who don't know, can you explain what a stablecoin is and why there's so much excitement around this?
Sure. So a stable coin is a type of cryptocurrency that's designed to maintain a stable value, uh, basically being backed or pegged to a reserve asset like a fiat currency. So you get a lot of the benefits of a real currency like the dollar. You have which is stability, right? You have stability and fungibility. But the thought is you also get the benefits of the blockchain and crypto, which really it's fast transactions, like instantaneous. So optimists out there might say that stable coins are if a bank were to, like, suppose JP Morgan instituted their own stable coin, that could revolutionize the way that they're moving money within their ecosystem, and how it relates to the overall economy. So optimists might say that it might revolutionize the banking system. So and it might do so without. It's not like it's challenging the dollar or anything like that. In fact, it's utilizing the dollar. So it's really interesting. And the Genius Act, I think, is important because it provides a framework in legislation so that banks can kind of know what they got to do. They know what the I guess the rules of the road are going to be, so that they can start building their systems and investing in these processes, basically like paving the way for the future of banking. And just real quick while we're on it, I would also mention that there's another big bill that's kind of hanging out there. It's called the Clarity Act. It's kind of similar to this bill, but it's aimed at crypto at large, and that would give that would give guidelines and regulation kind of around the whole crypto universe, kind of pave the way for further institutional investment and interest in the crypto space. So there's more of a sweeping, I guess, wider ranging impact from that bill, and that should be potentially later this year or early next year. So look for that.
Kevin, I think when you think about how it's changed over the last 20 years of how we can transfer money, it's pretty remarkable when you think about it and what stablecoin will do in that case. I remember when we bought our first home and it took like 4 or 5 days to transfer the money to get the down payment done. And now it can, with stablecoin, it can be done instantaneously if in fact this works, especially across borders. So there are real advantages there for investors. But Chris, could you tell us, is there money to be made here?
As Kevin stated, this is really an asset that's sort of a stable asset. There's not necessarily money to be made from this, but I think important to think about is that there's going to be more competition. As Kevin said, the banks and fintech companies are going to get into this space. There's just going to be a lot more competition and a lot more access for investors to use stable coins. And as Kevin said, it's important. There really was no regulatory framework before. So stable coins weren't as used because they didn't have anything backing them. And now there's reserves that have to be back these stable coins. So it's very important for investors. You can invest in Circle, which came out in June as an IPO, which is a stablecoin platform. The stock has gone from $30 to $230. So I'm not sure now's the right time because obviously the stock moved up well in anticipation of the Genius Act passing. But that's one way you could invest in stablecoins by investing in the platform, which Circle is leading.
That's right. Well, let's move into our third story. We're going to dig a little bit deeper into tariffs and their effects. The president said this week that a deal with India and England is close, but not with Canada. He's also sending out letters. He's been very busy sending out 150 more countries, warning them of the tariff rates if they don't reach these deals by August 1st, which is coming up quickly. Meanwhile, the actual effects of tariffs and people and their concerns about tariffs are being exposed. The University of Michigan Consumer Survey just came out this morning and shows that the worst fears about inflation have since receded. But consumers are still concerned inflation could peak in Q3 or potentially Q4. I've talked a lot about how I live near the port of Oakland, and it's reported that more than 10% drop in shipments arriving there in the past month since June. So we are starting to see the impact, and they're already thinking about laying off people because shipments are so far down. But Chris, the Consumer Price Index, or CPI, was also released this week. It was up, core inflation numbers. However, PPI, or Producer Price Index, which measures wholesale costs, showed no change in June. How should we be interpreting this data, and what does it mean for markets and portfolios?
Yeah, I think Kevin touched it on the beginning. You look at the inflation numbers that just came out, they were very benign. Certainly the total effects of tariffs have not been felt yet, but I think when you look at the reports that just came out, you can say that, as Kevin stated before, economists were looking for like 4% inflation and it ticked up to 2.7. So as of now, inflation really isn't a concern that we've seen so far. That could change in the coming months. And really how it affects your portfolio and what we've been focused on is really bond yields. Bond yields, when the CPI number came out, bond yields spiked a little bit. And then for the rest of the week, they've kind of come back down and kind of really unchanged for the week. But if bond yields continue to go up, that's going to be very bad for the equity markets. And there's no way that equity markets can continue to go higher if bond yields spike from here. So inflation is very important to watch. Tariff rates are very important to watch. As of now, in our opinion, it's not a concern, but that certainly would affect your portfolio. But I don't think you'd want to change your asset allocation based on tariff news.
Yeah, I agree. And Kevin, you do this every day. You're a portfolio manager. You run a firm based on always doing what's best for clients. What will be the signal to you that it's probably time to shift assets or not due to tariff pressures, or what could the shifts look like?
Yeah, so I think Chris answered a lot of that, and I obviously agree with him wholeheartedly. I mean, we're watching the CPI numbers in earnings really, because I think those are the two spots where tariff trouble would translate in. Some of the surveys too, I think would be important, but um, I would say that really none of that has been impacted much yet. And so when you think of tariffs are a tax, right? Tariffs, they don't increase demand. It probably doesn't. It probably makes sense that you don't need to manage tariffs with monetary policy necessarily, especially if the numbers aren't showing up. So, I mean, if anything, I think tariffs might actually slow the economy a bit, just like any tax does. Anytime you're taxing something, you're taking you're taking money out of the economy. People have less money to spend. So I don't know. I think focusing on earnings, focusing on CPI, and like Chris said, we're always focused on, especially right now, on yields, bond yields, and so we don't want to see 10-year Treasury up over 4.5 or 5%. As far as the portfolio, right now we're not making any strategic shifts with regard to tariffs, but I would say that we're appropriate in client portfolios. We have strategies that are employ tactical risk management, and so what those portions of the accounts, what those strategies do, is when there is volatility, when we read volatility in markets, we can reduce exposure to risk assets, and so it helps manage the ride through a recession or through a global crisis or a pandemic like we just had, or we had in 2022 with inflation scare. So we don't know where the next source of turmoil is going to come from. It's probably honestly something that we're not talking about yet because we don't know. That's how it works, right? But whatever it is, we have risk controls built into portfolios to manage that risk and to make sure clients have the liquidity they need and to help manage downside when it inevitably shows up.
That's right. Now let's get on to our big topic. It was really sparked this week by Westinghouse planning to build 10 large nuclear reactors in the coming years. Is this a big signal that nuclear energy is now coming back? It's being positioned as a core part of global energy transition. So that's good news. But on top of that, an already good year for uranium investors, as uranium ETFs have been among the best performing assets in quarter two. But it isn't the only metal that's seen big gains this year. Gold has hit its all time record high. Silver hit a 14-year high. Copper has been wobbly this year, but analysts do see a big upside long term. Same for other rare earths. Our viewers have been asking a lot of questions about investing in metals. So let's start with Alex in Louisville, who simply wants to know, why are metals having such an upward trajectory? Kevin, do you want to take that one?
Sure, I'm happy to. Well, I think there's been some really good reasons for metals to be moving in the way that they have. We'll just kind of go in order. You mentioned uranium. I mean, I look at the uranium miners ETF. It's looking at it right now. It's doubled since the low in April. So 100% return there. But uranium's used in nuclear power development. That's a huge initiative for the U.S., highlighted by demand for AI and data centers in general. Tech companies are building huge facilities near these power plants or where the future sites of these power plants are going to be. Um, Gold and silver, you mentioned, those are perceived safe havens, so they're going to benefit from fears over the national debt and deficits, and we certainly have had a lot of that this year. The dollar's declined a lot this year. We talked about that 2 weeks ago. So that benefits kind of these perceived safe havens like gold and I guess silver. Copper, huge in the power transmission, electricity. We need more of that as we build out our power sources and the transmission grid. It's economically sensitive, so if the economy's hanging in there, that's a good thing. And also copper is going to potentially be tariffed, which means that the price is going to go higher because it's going to reduce foreign supply, and it's going to allow domestic prices to elevate with less competition from foreign sources. And rare earths. Everyone's talking about rare earths because of China is the big producer of rare earth elements these days, but they're used in magnets, which are a big piece of EVs. They're used in power generation, smartphones, tablets, all that sort of stuff, national security stuff like defense. So obviously, trade issues that we've had this year, have been a good catalyst for anything that has to do with rare earths in general. So a lot of supply issues here, a lot of demand issues, a lot of trade related issues, kind of all going in the same direction of sending these things higher, so you can see why they've done so well.
Yeah, I learned that recently that, I'm in California, the land of EV cars, that EV cars use 4 times more copper than gasoline cars. So that was a new trivia for me. So you can see why demand may be high there. And grid expansion and AI data centers are also driving huge demand on copper. So lots of opportunities for investing there. We're going to get on to our next question. And this is Carl in Biloxi. Chris, this question is for you. Carl wants to know which metal or metals are best to get into for someone who is new to investing in this space.
I think that's a great question. There's someone who's new investing in this space, as Kevin just went through, the uranium and the copper and the gold and the silver. The one thing about investing in metals is it's very volatile, and prices can go up and they can go down just as quickly depending on supply and demand. Right now, as Kevin stated, there's a lot of good reasons why metal prices are going up, but things can change. So when we talk to clients about exposure in areas like this where they're just starting to get invested in, it makes sense to invest in a broad ETF that has exposure to many different of these metals and commodities. So an ETF or a mutual fund where you can get some silver, some gold, some copper exposure, and maybe even some mining exposure, like that makes sense rather than just picking like a palladium because it's done so well. So that's where I would lead to looking at a broad ETF that has different metal exposures in there.
Yeah, that's right. And our last question is Frank from Chicago, who wants to know which metal would be best for a short-term investment and which metal might be best for a long-term investment. Kevin, how about answering the short term?
Sure. In general, we're not short-term investors, we're not traders, and we're investing for the long run. But in general, I would say that I like the idea in this space of buying things that have a potential paradigm shift in the future. So, like for example, uranium. I think that's a spot that would make sense to try to get some exposure. But remember, I don't like buying physical commodities at all-time highs. These are metals; they don't pay dividends. They don't have earnings growth that can propel them higher. It's simply supply and demand. And so trends can go on for a while, but they can also reverse course. So I guess an idea, and Chris kind of mentioned this earlier, but a way to play that would maybe be some mining companies, that are investing in, or I'm sorry, that are mining uranium, copper, rare earths, stuff like that. There are ETFs out there. There's I don't want to give a specific. This is not a recommendation, but for example, Global X has one invested in uranium miners. It's simply URA. Someone can look at that. It's up a lot. You might not want to buy it right this minute, but like Chris was saying, when you buy these ETFs, it's a basket. You're buying a lot of positions with one. You have that diversification. Yes, they're all tied to the same industry, but you don't have that idiosyncratic risk of any one company having a lawsuit or something that could derail them. So, that would probably be a way to play it. I would say, remember, all these areas that we just talked about, in all the metals, they're all economically sensitive. They're all going to get hit if there's a recession. So you really want to be watching the overall economy, and you don't want to be in these things if things are going to slow down in the economy. Which again, we don't see recession right now, but that would definitely be a short-term signal to kind of run. But so these things, I think investors should be looking to buy on dips if possible. So there's some tailwinds here, but let's not get too far over our skis.
Yeah, so Kevin covered the short term. Chris, I know you've been thinking about this. What would you recommend for a long-term investor?
Well, I think you stated it. You answered the question very well before, Terry. Copper is sort of is a great long term play because it hasn't seen the same rise as the other metals. And as you said, the electrification of this country and the data centers that are going to be built, copper is going into everything AI related and electrification. So, a great long term play for investors is to own copper.
Yeah. And I just want to remind everyone, because Kevin and Chris are fiduciaries, and so we always do what's right for our clients. And so when we have these conversations, we want to think about it within your overall portfolio as investors. And so please, it's not just one or two, it's what does it mean for your portfolio? What's your risk tolerance? What's your age? What's your time horizon? Because as both Kevin and Chris mentioned, there is a lot of volatility in these metals. And so I'd really highly recommend you get an advisor, a fiduciary like Chris or Kevin, and you do a portfolio review. Go to wealthion.com, take a look at it, get all of your questions answered just before quickly investing in something that is certainly hot right now, but could change very, very quickly. Now, what I'd like to move on is our next stories for next week. So, our three big stories. We'll be getting U.S. leading economic data dropped on Monday. Chris, what are you expecting?
Yeah, well, we've seen over the last couple of months really declines in the leading economic indicators. That could also be because of the tariff news, but sort of the 6 month averages are down about 2%. And so when you look at the June readings, the leading economic indicators look at housing, they look at employment, they look at manufacturing, they look at consumer confidence, they look at stock prices. So a lot of these readings are already out for June, and what we can see is that it's a mixed bag. As we started at the beginning, as Kevin stated at the beginning, there's some things that are a little weaker and there's some things a little stronger. Stock prices are up. Consumer confidence was down a little bit in June. Manufacturing improved a little bit in June. Housing numbers improved a little bit in June. So I would expect probably a very stagnant number, not up or down, would be probably my guess when you look at the readings. But the leading economic indicators are supposed to give you kind of a read into the next 6 to 12 months. That's really what their goal is. And for the last 6 months, it's been showing declines, which we haven't seen when we look at GDP numbers. So it's very interesting. I would expect it not to be a huge negative or huge positive, maybe around 0% or so.
Great. And the next one is a real hot potato right now. Fed Chair Powell is speaking at the banking conference this next week. Kevin, what are your thoughts on him addressing Governor Waller's call today for an interest rate cut or the rumors that he's soon to be fired?
Yeah, right. Powell has carried himself very well. Has stayed above the fray. He hasn't been dragged into any sort of mudslinging, and I don't expect that to change next week. Um, I'd be very surprised if he addressed directly any comments from the White House. Although, with regard to Waller's comments, I'm sure he'll acknowledge that there is debate going on at the Fed regarding interest rate policy, and that there is the potential for rate cuts. I mean, I personally think there probably should be rate cuts sometime soon, and that we're probably well above a neutral rate, and there's room to bring things down. So I also probably say that he's going to stay, or they will stay data dependent, and he'll highlight that they stand ready to move if the jobs market were to weaken, or if some of the information, the economic information post tariff impact warrants it.
That's right. I think it's so interesting because Powell's actual term, his 4-year term, runs out in May of 26. And I don't know if you guys knew this, but there's never, ever been a Fed chair who's actually been fired, ever, historically. Even presidents who've strongly disagreed with their Fed chairs did not necessarily attempt removal of them. So this will be very, very interesting in the next week as we watch this. Uh, And lastly, earnings reports are out next week, including Tesla, Alphabet, Coca-Cola, which the president says is bringing cane sugar back to its sodas. Kevin, Chris, what are you expecting next week, especially on Tesla?
Yeah, I would expect as we started the call that especially like Google's earnings will continue to Alphabet's earnings will be good. YouTube, you get a read through with Netflix on the streaming side. YouTube continues to do very well. I think the death of Google's search is not real. They'll continue to do well in search. Coca-Cola will probably do very well. I think earnings will continue to do very well. As far as Tesla goes, deliveries are already out. They've disappointed there, but investors are really looking for the autonomous vehicles, the robo-taxis being started in Austin, Texas. Probably get some feedback on that from Tesla, as well as any regulatory announcements or any color they can give on future robo-taxi launches is probably what investors are looking for, as well as the continued acknowledgement that they're going to come out with lower cost vehicles. So more news on that and more news on the robo-taxi is really what's going to make this stock go up or down, not the deliveries.
Kevin, any thoughts on next week?
No, I'm looking forward to earnings. Earnings have been pretty strong thus far. Yeah, Tesla will be interesting. It always is. We don't own Tesla. There's been, as you know, a fair amount of departure of key executives there. So I think some of the short-term news in Tesla is probably pretty bad, but everyone knows that. And like Chris said, everyone's kind of looking through to see what the next act is going to be or when the next act is going to be, because it seems like it keeps it's like running at the horizon, right? It keeps going out. So, but we'll see. We'll see what happens there. And yeah, looking forward to next week. And that's all I got.
Okay, well, I do have to end at least with one joke, because the president did say that he's bringing cane sugar back to Coca-Cola. So why did cane sugar just recently get promoted?
Why, Terry?
Because it refined its approach. See, that's the best I can do, but we always have to leave with something fun. But our mission here at Rise is to bring the best minds to your wealth management process. If you have questions about your portfolio, if you want help in making big life decisions or on your portfolio or financial plan, please go to Wealthion.com and sign up for a free portfolio review so advisors like Kevin and Chris can help you out. And if you have any questions, please drop them in the comments box. We will answer them. Please subscribe. And thank you so much for watching us at Rise Up this week. And I want to especially thank Kevin and Chris for joining us.
My pleasure. Thank you, Terry.
Thanks, Terry. Thanks for having us.
Yeah, have a great weekend, you guys.
You too.
You too.